Today we will tell you about asymmetric risk-reward.
Got a coffee break? Embrace your inner wolf, step up. Forget titles and hierarchies. It's all about problem solving. Lead or follow to ignite outcomes. Play your part, embody our brand. Zero excuses. Build your wolf pack, savor victory. Validate your expertise, attain mastery. The road to freedom awaits. Engage, flaunt our brand. Unleash your power at buildyourwolfpack.com. Unleash now at buildyourwolfpack.com.
An asymmetric risk-reward is an imbalance between the risk and the reward. Thinking in terms of risk-to-reward ratios, a positive asymmetric risk-to-reward is when the risk taken was less than the actual profit, or when the potential for gain is greater than the potential for loss. 6. Asymmetric risk-reward. Asymmetric risk-reward, then, can be expressed as either the potential risk versus reward of an investment position or trade, or the actual outcome of a position taken. The potential asymmetric risk versus reward of an investment position or trade is an asymmetric risk-reward setup. When we speak of asymmetric risk-reward outcome of a closed position that has been bought and sold, we are speaking more of asymmetric payoff. Asymmetric risk-reward can also involve the asymmetry of profit and loss distribution of the entire portfolio, or the asymmetric risk-reward profile of a portfolio monthly return data. We call these asymmetric return distribution and asymmetric risk-reward ratio. A positive asymmetrical risk-reward occurs when a potential or realized reward is greater than the potential or realized loss. When we speak of asymmetrical risk-reward, we typically mean it is a positive one, but an asymmetric risk-reward can also be negative. Asymmetric risk is the risk an investor faces when the gain realized from the move of an underlying asset in one direction is significantly different from the loss incurred from its move in the opposite direction. Asymmetric reward is the reward an investor may achieve when the gain realized from the move of an underlying asset in one direction is significantly different from the loss incurred from its move in the opposite direction. 5. Life-changing magic of asymmetrical risk. Asymmetrical risk is the concept of taking a risk that will produce a return that far surpasses the risk taken. This is a really important concept that can change your quality of life greatly. Yet, the idea of leveraging asymmetrical risk is not really emphasized in today's world. Asymmetrical risk is like using a lever and prop to move a large boulder. There are times when the lever will snap in half. There will be times when the prop is crushed by the pressure involved, but there will also be times when the boulder is moved. Without asymmetrical risk being present, it is similar to pushing that large boulder with your bare hands in a futile hope of trying to move it. Asymmetrical risk applies to all corners of life and throughout the ages. There are definitely more recent examples of asymmetrical risk. Here's one from stock investing in recent times. If you invested in Amazon in 2001 during the dot-com crash and held the stock to today, you would have made almost 300 times your initial investment. So if you invested $10,000 in Amazon in 1999, you would have made almost $3 million by today. But what if I told you that in 2001, the market had saw Amazon's stock price go from over $100 in 2000 to just $5 in 2001? Would you still invest? This is an aspect of asymmetrical risk. You do not have perfect information. Perfect information is having all the data needed to make the correct decision. In the case of Amazon, investors likely knew that e-commerce was a fast-growing trend, but they did not know which company would thrive in it. When there are asymmetrical risk opportunities, there will likely never be perfect information available for you to decide whether to take that opportunity. 4. Asymmetrical risk is present in our professional lives. When Google announced its IPO, it made 900 people instant millionaires. It is easy to say at the time or any time after that joining or working for Google would be a good idea. Those instant millionaires paid a price, but they only paid a small price compared to the reward they got. Those 900 people took an asymmetrical risk opportunity to become instant millionaires. When Google was starting out, not many people were sure that it would become the company it would be today. There are definitely some employees that lost out opportunities at more established companies to work at Google. The price, read risk, they would have paid if Google remained small would have been the loss of income and time, but the reward of becoming a millionaire offsets that easily. This is yet another aspect of asymmetrical risk. This notion is that sometimes when you take on asymmetrical risk opportunities, you will have to sacrifice your most valuable resource, your time. In the case of Google, if the company were to have flamed out, then the cost would have been the loss of time to the employees and the founders. But that is likely mitigated by the experiences you gain while working there. Further, if an asymmetrical risk opportunity will take a lot of time to achieve, you should be sure that it is a worthy cause, or something you are passionate about. 3. Asymmetrical risk is also present in our social lives. Can you recall one conversation that you had or one experience that you had that changed your life for the better? The thing is, you may have been presented with experiences or situations where if you acted, they would have happened. The reward is the conversation or experience you would have had, and the risk was the other party saying no. Many people are so scared of being overlooked that they do not take the asymmetrical risk and ask for the opportunity. If the other party says no, nothing will happen, but if the other party says yes, you open the doorway to great rewards. This is the concept of asymmetrical risk. It does not favor those that stand still. Sometimes, to attain the reward in an asymmetrical risk situation, you will have to risk your well-being or make a drastic change in your way of life. But oftentimes, it does not require even great feats of action or effort. Sometimes all it requires is a decision, such as you asking a question or you using a renewable resource, i.e. money for investing. 2. Are asymmetric investments worth the risk? When investing, there's no such thing as absolute certainty. However, asymmetric investments are identifiable scenarios in which the reward inherently outweighs the downside risk. By their very nature then, asymmetric trading and highly asymmetric investments are worth the risk. You can amass significant wealth by making asymmetric trades, or buying into an index fund that specializes in asymmetric trading. The difficulty is in identifying trading scenarios or opportunities that, with a high degree of confidence, have a positive reward-risk ratio. 1. Examples of asymmetric investments. Life insurance is an example of a highly asymmetric investment. When you buy the policy, you pay a relatively small premium compared to the payout if the worst happens. Or you can think of selling life insurance policies as going long on the unlikely event of one policyholder's death. Insurance companies sell thousands of life insurance policies, knowing that only a few will result in the untimely event of death. So they have a very high upside and a limited downside, which is a perfect example of asymmetric investing. Another example of an asymmetric investment is a catastrophe bond. These types of high-yield bonds are issued to insurance companies to mitigate the risk of a natural disaster such as an earthquake or hurricane. You can think of catastrophe bonds as a form of an asymmetric debt instrument whereby the reinsurer is taking a long position on an unlikely natural disaster not occurring. Equities in the natural resources sector tend to offer highly asymmetric reward profiles. As one of the market's most volatile sectors, natural resource stocks undergo rapid boom and bust cyclicality. For instance, oil futures experience some of the highest degrees of volatility due to their inherent responsiveness to short-run shocks to supply and demand. Look no further than the year-over-year movement of West Texas Intermediate (WTI) crude oil prices over the past 4 years. 2016, plus 45.03%. 2017, plus 12.47%. 2018, minus 24.84%. 2019, plus 34.46%. 2020, minus 31.87%. 2021, plus 55.01%. 2022, plus 46.91%. Given the inherent cyclicality of crude oil prices, the commodity presents an asymmetric investment opportunity if you assume that the chance of the commodity's price increasing is greater than the chance of it staying the same or lowering. Finally, investing in Bitcoin, BTC, during its infancy presented an asymmetric trade opportunity because the downside risk of losing $9.35, the price of one BTC in July 2012, was dwarfed by its upside potential in the likely event of mass adoption. What do you think about this asymmetrical risk-reward phenomena? Thanks for watching.